Hi everyone, my name is Ryan. So how are you? I hope you're feeling peachy because we're going to talk about cryptocurrencies today. Are you ready? Come on guys, you need to know about that. It's important, man. Come on. I've received 100 questions and I'll be able to answer them. You're all set, so let's get started. Question 1, what are cryptocurrencies? So cryptocurrencies are digital or virtual currencies that use cryptography for security and operate on decentralized networks based on blockchain technology. Question 2, how do cryptocurrencies differ from traditional currencies? So, unlike traditional currencies issued by governments, cryptocurrencies are decentralized and not regulated by any central authority, making them immune to government interference. Question 3, what is blockchain technology? So blockchain is a distributed ledger technology that records all transactions across a network of computers in a secure, transparent, and immutable way. Question 4, can you explain what Bitcoin is? So Bitcoin is the first and most well-known cryptocurrency, created in 2009 by an unknown person or group of people using the name Satoshi Nakamoto. Question 5, how is Bitcoin mined? So Bitcoin is mined through a process called proof of work, where miners solve complex mathematical problems to validate transactions and add them to the blockchain. Question 6, what is a cryptocurrency wallet? So a cryptocurrency wallet is a digital tool that allows users to store, send, and receive cryptocurrencies securely. Question 7, what types of wallets are there? There are several types of wallets, including hardware wallets, software wallets, desktop wallets, mobile wallets, and paper wallets. Question 8, what is altcoin? An altcoin is any cryptocurrency other than Bitcoin. Examples include Ethereum, Ripple, and Litecoin. Question 9, what is Ethereum? So Ethereum is a blockchain platform that enables developers to build decentralized applications, dApps, and smart contracts using its native currency called Ether, ETH. Question 10, what are smart contracts? G. Smart contracts are self-executing contracts with the terms of the agreement directly written into code. They automatically execute and enforce the terms once predetermined conditions are met. Question 11. What is a decentralized exchange? DEX. A decentralized exchange is a platform that allows users to trade cryptocurrencies directly with one another without the need for an intermediary or central authority. Question 12. What is a cryptocurrency's market cap? Market cap refers to the total value of a cryptocurrency, calculated by multiplying its price by the circulating supply of coins. Question 13. Why is the price of cryptocurrencies so volatile? Cryptocurrency prices are influenced by factors such as market sentiment, regulatory news, technological developments, and speculative trading, which can lead to significant price swings. Question 14. Hat is a hash in cryptocurrency? So a hash is a function that converts an input into a fixed size string of characters, which serves to secure and verify transactions on a blockchain. Question 15, what does mining reward mean? A mining reward is the incentive given to miners for validating transactions and securing the network, usually provided in the form of the cryptocurrency being mined. Question 16, what are initial coin offerings, ICOs? An ICO is a fundraising mechanism where new cryptocurrencies sell tokens to investors in exchange for established cryptocurrencies like Bitcoin or Ether. Question 17, what is a stablecoin? So a stablecoin is a type of cryptocurrency designed to maintain a stable value by pegging it to a reserve of assets, typically a fiat currency like the USD. Question 18, can you explain what DeFi is? DeFi, or decentralized finance, refers to a movement that aims to recreate traditional financial systems like banking and lending using decentralized technologies on blockchains. Question 19, what is a non-fungible token, NFT? An NFT is a unique digital asset that represents ownership of a specific item or piece of content on the blockchain, such as digital art or collectibles. Question 20, how can someone buy cryptocurrencies? People can buy cryptocurrencies through exchanges, brokers, or peer-to-peer platforms using traditional payment methods like credit cards or bank transfers. Question 21, what are gas fees in Ethereum? Gas fees are transaction fees that users pay to compensate miners for validating and processing their transactions on the Ethereum network. Question 22, what does HODL mean? HODL is a misspelling of hold, which refers to the strategy of keeping onto cryptocurrencies rather than selling them, especially during market volatility. Question 23. What is a cryptocurrency fork? A fork occurs when a blockchain's protocol is changed, resulting in two separate chains. This can happen for upgrades or disagreements within the community. Question 24. What is FOMO in cryptocurrency? FOMO stands for fear of missing out, a psychological phenomenon where investors buy cryptocurrencies because they fear losing potential gains. Question 25. What does rally mean in crypto trading? A rally refers to a period of sustained price increases in a cryptocurrency, often driven by market enthusiasm or positive news. Question 26. What are whales in the crypto market? Whales are individuals or entities that hold large amounts of cryptocurrency, which can significantly influence market prices with their trades. Question 27. What is the purpose of a white paper? A white paper is a technical document that outlines a cryptocurrency project's goals, technology, and implementation plan to attract investors and inform the public. Question 28. How do you secure your cryptocurrency investments? Securing investments involves using strong passwords, enabling two-factor authentication, using hardware wallets, and being wary of phishing attacks. Question 29. What is market liquidity? Market liquidity refers to how easily an asset can be bought or sold in the market without affecting its price. Higher liquidity typically means less price volatility. Question 30. Can you explain what a token is? A token is a digital asset that represents a unit of value on a blockchain and can be used for various purposes within its ecosystem, such as utility or governance. Question 31. What is the significance of proof of stake, POS? The answer, proof of stake, is an alternative consensus mechanism to proof of work that allows users to validate block transactions based on the number of coins they hold, which is more energy efficient. Question 32. Can cryptocurrencies be used for everyday transactions? The answer, yes, many businesses and online platforms accept cryptocurrencies as a form of payment for goods and services, although adoption varies widely. Question 33. What is a public key? The answer, a public key is a cryptographic code that allows users to receive cryptocurrencies into their wallets and is shared with others for transaction purposes. Question 34. What is a private key? The answer, a private key is a secret cryptographic key that must be kept confidential, as it grants access to the cryptocurrency stored in a wallet and allows users to initiate transactions. Question 35. What does scalability refer to in relation to cryptocurrencies? The answer, scalability refers to the capability of a blockchain network to handle an increasing number of transactions efficiently and without congestion. Question 36. What is the purpose of a cryptocurrency exchange? The answer, a cryptocurrency exchange is a platform that facilitates the buying, selling, and trading of cryptocurrencies between users. Question 37. What are transaction confirmations? Transaction confirmations indicate that a transaction has been validated by the network and added to the blockchain, enhancing its security. Question 38. What does going viral mean in crypto terms? In crypto, going viral refers to a cryptocurrency or project gaining sudden popularity and attention on social media, often resulting in spikes in its value. Question 39. What are centralized exchanges? CX. Centralized exchanges are platforms that act as intermediaries for buyers and sellers, providing more user-friendly experiences and higher liquidity compared to decentralized exchanges. Question 40. What is market sentiment? Market sentiment is the overall attitude of investors toward a particular cryptocurrency, or the market in general, often influenced by emotions and news. Question 41. How does regulation affect cryptocurrencies? Regulation can provide legitimacy and security for cryptocurrencies, but may also impose restrictions that can hinder innovation and the adoption of cryptocurrencies. Question 42. What is the role of a blockchain explorer? A blockchain explorer is an online tool that allows users to view and search for transactions, addresses, and blocks on a specific blockchain. Question 43. What is the significance of having a roadmap for a cryptocurrency project? A roadmap outlines a project's goals, milestones, and planned developments, providing transparency and helping to build trust with investors. Question 44. What is yield farming? Yield farming is a practice in DeFi where users lend their cryptocurrencies to earn interest or rewards, often by providing liquidity to various protocols. Question 45. What are the risks associated with investing in cryptocurrencies? Risks include market volatility, regulatory changes, technological vulnerabilities, and potential scams or frauds prevalent in the cryptocurrency space. Question 46. What is a governance token? A governance token grants holders the ability to participate in the decision-making processes of a decentralized protocol, influencing its future direction. Question 47. Can you explain what a security token is? The answer: security tokens represent ownership in an underlying asset or company and are subject to federal securities regulations, offering more legal protection for investors. Question 48. What is crypto lending? Crypto lending allows individuals to lend their crypto assets to others in exchange for interest, typically facilitated by platforms that match borrowers with lenders. Question 49. What are the environmental concerns surrounding cryptocurrencies? The energy-intensive nature of mining, particularly for proof-of-work cryptocurrencies, raises concerns about their environmental impact and carbon footprint. Question 50. What does the future hold for cryptocurrencies? The future of cryptocurrencies may involve increased adoption, regulatory clarity, advancements in technology, and improvements in security and scalability, but it remains unpredictable. Let's move on to some complex questions about cryptocurrency. Question 1. What is the Byzantine generals problem, and how does it relate to cryptocurrencies? The Byzantine generals problem is a situation in distributed computing where multiple parties must agree on a single strategy to avoid failure, despite the presence of some adversarial actors. Cryptocurrencies solve this problem using consensus mechanisms, like proof of work or proof of stake, to ensure that all honest participants can reach agreement on the state of the blockchain. Question 2. Can you explain the significance of the Merkle tree in blockchain technology? A Merkle tree is a data structure that efficiently summarizes and verifies the integrity of large sets of data in a blockchain. It allows secure and efficient verification of transactions by storing hashes of transaction pairs, enabling quick checks without needing to review all individual transactions. Question 3. How does the concept of digital scarcity apply to cryptocurrencies? Digital scarcity refers to the limited availability of certain digital assets, most notably Bitcoin, which has a capped supply of 21 million coins. This notion drives value, as scarcity can lead to increased demand, similar to precious metals in the physical world. Question 4. What role do oracles play in blockchain ecosystems? Oracles are third-party services that provide smart contracts with real-world data, enabling them to execute based on external information like asset prices, weather conditions, or sports scores. They bridge the gap between the blockchain and the outside world. Question 5. Can you discuss the differences between proof of work, POW, and proof of stake, POS? Proof of work requires participants, miners, to solve complex mathematical problems to validate transactions and secure the network. This process is energy intensive. In contrast, proof of stake allows participants, validators, to create new blocks and validate transactions based on the quantity of coins they hold, promoting energy efficiency and encouraging long-term investment in the network. Question 6. What is the difference between hard forks and soft forks in blockchain protocols? A hard fork is a significant change that is not backward compatible, resulting in a split into two separate blockchains. A soft fork, however, is backward compatible and allows for limited changes without disrupting the existing protocol. Such distinctions are important for community consensus and the future trajectory of projects. Question 7. What are rug pulls and how can investors protect themselves against them? A rug pull is a malicious act where developers abandon a project or manipulate it to benefit personally, typically by withdrawing liquidity while leaving investors with worthless tokens. Investors can protect themselves by researching the project's team, checking for audits, and scrutinizing liquidity lockups and project transparency. Question 8. How do network effects influence the value of a cryptocurrency? Network effects occur when the value of a cryptocurrency increases as more users adopt it, creating a virtuous cycle of utility and value. As a network grows, its security and acceptance among merchants improve, further incentivizing new users to join, thus enhancing its overall worth. Question 9. Can you explain the significance of transaction finality in blockchain networks? Transaction finality refers to the point at which a transaction can no longer be reversed or altered. Different networks achieve finality through various mechanisms, and the speed and certainty of finality impact a cryptocurrency's usability for everyday transactions and its overall reliability. Question 10. Why is the difficulty adjustment important in the Bitcoin mining process? The difficulty adjustment ensures that blocks are added to the Bitcoin blockchain approximately every 10 minutes, regardless of the total mining power on the network. This process maintains network stability and predictable transaction confirmations while preventing excessive energy consumption. Question 11. What are the implications of quantum computing on cryptocurrency security? Quantum computing poses potential threats to cryptocurrency security since it could efficiently break traditional cryptographic algorithms used in public key systems. The development of quantum-resistant algorithms is crucial to ensure the long-term viability of cryptocurrencies as quantum technology evolves. Question 12. How does Ethereum 2.0 address the scalability issues faced by the original Ethereum blockchain? Ethereum 2.0 aims to improve scalability through transitioning from proof of work to proof of stake, which allows for sharding. Sharding divides the network into smaller pieces, shards, enabling parallel transaction processing and significantly increasing overall throughput. Question 13. Can you explain the concept of tokenomics? Tokenomics refers to the study of the economic principles governing a token within its ecosystem, covering aspects like supply and demand dynamics, distribution methods, utility, inflationary or deflationary mechanisms, and its overall impact on the network's health and operation. Question 14. What is a Sybil attack, and how can it be mitigated in a blockchain network? A Sybil attack involves an adversary creating multiple identities to manipulate or gain control over a network. Mitigation strategies include implementing proof of work, proof of stake, and other consensus mechanisms that require real investment or resources to participate in the network. Question 15. How can token standards like ERC-20 and ERC-721 influence blockchain development? ERC-20 standardizes the creation of fungible tokens on the Ethereum blockchain, simplifying interoperability and the development of decentralized applications, dApps. ERC-721, on the other hand, facilitates the creation of non-fungible tokens, NFTs, enabling distinct assets to be uniquely identified and traded, thus expanding use cases beyond simple currencies. Question 16. What challenges do privacy coins such as Monero or Zcash face with regard to regulation? Privacy coins face significant regulatory challenges due to concerns over potential use for illicit activities. Governments argue that enhanced anonymity could impede law enforcement efforts, leading to stricter regulations or outright bans in some jurisdictions. Question 17. How does the Lightning Network aim to resolve Bitcoin's scalability concerns? The Lightning Network is a Layer 2 scaling solution that allows users to create payment channels off-chain, enabling rapid, low-cost transactions. This approach alleviates congestion directly on the Bitcoin blockchain while retaining the security of the underlying network. Question 18. What is a liquidity crisis in the context of cryptocurrency exchanges? A liquidity crisis occurs when there are insufficient funds to facilitate trades, such as when many users attempt to withdraw their assets simultaneously. This can lead to increased slippage, difficulty executing orders, and a subsequent loss of trader confidence in the exchange. Question 19. How do governance models differ across various DeFi platforms? Governance models can range from centralized governance, where a core team controls decisions, to decentralized governance, where token holders vote on proposals. Some platforms implement quadratic voting to prevent domination by large holders, while others use simple majority voting. Question 20. What is the role of validators in a proof-of-stake network? Validators are participants who stake their cryptocurrency to secure the network, validate transactions, and propose new blocks. In return for their services, they earn rewards. This system encourages good behavior, as participants have a financial stake in the network's integrity. Question 21. Can you explain the importance of a consensus mechanism in blockchain technology? Consensus mechanisms are vital for ensuring agreement among decentralized participants on the state of the blockchain. They prevent fraud, ensure network security, and enable trustless interactions, which are fundamental to the operation of cryptocurrencies. Question 22. How do transaction fees work in a blockchain, and why are they essential? Transaction fees compensate miners or validators for their work in processing and confirming transactions. They also serve as an economic incentive to prioritize higher value transactions, which is crucial for maintaining network efficiency and preventing spam attacks. Question 23. What is an airdrop, and what are its potential benefits and risks? An airdrop is a marketing strategy where free tokens are distributed to holders of an existing cryptocurrency. Benefits include increasing awareness and adoption, while risks may involve potential regulatory scrutiny or dilution of token value. Question 24. What are the advantages of cross-chain interoperability? Cross-chain interoperability allows different blockchain networks to communicate and transact with one another, enhancing liquidity, broadening market accessibility, and facilitating the creation of more complex decentralized applications that leverage the unique features of multiple blockchains. Question 25. In cryptocurrencies, what are gas wars, and how do they affect users? Gas wars occur when multiple participants compete to get their transactions processed by outbidding others for higher transaction fees, often leading to inflated costs and delays for users. This can disproportionately affect those with fewer resources and discourage smaller participants. Question 26. How significant is the role of venture capital in the cryptocurrency ecosystem? Venture capital plays a crucial role in funding cryptocurrency projects, fostering innovation, and validating concepts. Their investments can help launch startups and provide the necessary resources for development and marketing, impacting their long-term success. Question 27. What is slippage in cryptocurrency trading, and how can it be minimized? Slippage refers to the difference between the expected price of a trade and the actual price at which the trade is executed. It can be minimized by using limit orders, trading during periods of high liquidity, and being aware of market conditions before placing orders. Question 28. What is a dusting attack, and how can users protect themselves from it? A dusting attack involves sending small amounts of cryptocurrency to numerous wallets to track the owner's transactions and balance. Users can protect themselves by using privacy coins, consolidating their funds into secure wallets, or conducting transactions through anonymous methods. Question 29. How do exit scams operate in the cryptocurrency space, and what warning signs should investors watch for? Exit scams occur when a project's team disappears with investors' funds after raising capital. Warning signs include lack of transparency, inability to provide verifiable project progress, anonymous teams, and excessively high promised returns. Question 30. What are flash loans, and how do they function within DeFi? Flash loans are uncollateralized loans taken out and repaid within a single transaction. They allow users to exploit price discrepancies or arbitrage opportunities without needing initial capital upfront, but they carry substantial risks, including potential smart contract vulnerabilities. Question 31. What challenges do stablecoins face in achieving regulatory compliance? Stablecoins must navigate complex regulatory frameworks concerning reserve requirements, transparency, and anti-money laundering (AML) policies. Successful compliance is crucial for ensuring trust and usability in traditional financial ecosystems. Question 32. How do decentralized autonomous organizations, DAOs, function? DAOs are organizations represented by rules encoded on a blockchain, enabling community governance through smart contracts. Members participate in decision-making based on token ownership, promoting transparent and democratic processes. Question 33. What are the potential impacts of CBDCs, central bank digital currencies, on digital currencies? CBDCs could either complement or compete with existing cryptocurrencies. They might drive mainstream adoption of digital currencies while also imposing stricter regulations, ultimately changing user behaviors and affecting the decentralization ethos of current cryptocurrencies. Question 34. How does the concept of market manipulation manifest in the cryptocurrency space? Market manipulation can take several forms, including wash trading, pump and dump schemes, and spoofing. Many of these tactics exploit market psychology and can lead to price distortions, significantly impacting retail investors. Question 35. What is the significance of composability in DeFi applications? Composability allows DeFi projects to work together and leverage each other's protocols in a seamless manner, similar to how web applications interact. This interconnectedness promotes creativity, innovation, and the development of complex financial products. Question 36, what are gasless transactions and how do they work? Gasless transactions allow users to interact with dApps without needing to hold native tokens for transaction fees. Instead, developers can sponsor transaction costs or leverage third-party relayers, enhancing user accessibility and experience. Question 37, how can regulatory uncertainty impact developer activity in the cryptocurrency space? Regulatory uncertainty may deter developers from building projects due to fear of potential penalties or legal repercussions. Unclear guidelines can stifle innovation, lead to the withdrawal of investments, and encourage developers to move to more crypto-friendly jurisdictions. Question 38. What is the significance of reputation systems in decentralized networks? Reputation systems help establish trust among participants in a decentralized network by tracking users' behaviors and contributions. They encourage accountability, improve user interactions, and mitigate risks associated with anonymity. Question 39. Can you discuss the implications of token dilution in a cryptocurrency project? Token dilution occurs when a project issues additional tokens, decreasing the relative ownership of existing token holders. While necessary for raising funds, excessive dilution can lead to reduced value and confidence among current investors. Question 40. What challenges does interoperability present between different blockchain networks? Interoperability challenges include differing consensus mechanisms, transaction formats, and programming languages. Developing protocols and standards that allow seamless communication while maintaining security and speed poses a significant technical hurdle. Question 41. How does impermanent loss affect liquidity providers in DeFi? E. Impermanent loss occurs when the value of assets in a liquidity pool diverges from holding those assets outside the pool. Liquidity providers may earn fees, but if market prices change significantly, they could face losses compared to simply holding their assets. Question 42. What are the implications of a 51% attack on a blockchain network? A 51% attack occurs when a single entity controls the majority of the hash rate in a POW system or stake in a POS system. It can lead to double spending, transaction censorship, and disruption of network consensus, undermining trust in the blockchain. Question 43. What role does decentralization play in enhancing cryptocurrency security? Decentralization distributes control and reduces the risk of a single point of failure. A more decentralized network requires a greater effort to compromise, making it inherently more secure against attacks and fraud. Question 44. How do social factors influence cryptocurrency market trends? E. Social sentiment on social media platforms, including news cycles, influencer opinions, and community interactions, can significantly influence market trends. FOMO and FUD, fear, uncertainty, and doubt, often drive emotional decision-making, impacting prices and trading volume. Question 45. What are the potential benefits and drawbacks of using stablecoins for remittances? Question 46. Stablecoins can reduce transaction costs and enhance speed for remittances across borders, offering users access to a more stable asset without the volatility of cryptocurrencies. However, challenges include regulatory scrutiny, technological barriers, and liquidity issues in receiving markets. Question 47. How does transparency in smart contracts contribute to their reliability? Transparency in smart contracts allows users to audit the code, review the logic, and verify functionality before interacting with the contract. This reduces the likelihood of hidden risks or malicious intent, thereby enhancing user trust and adoption. Question 47. What are shadow banking practices in the context of decentralized finance? Shadow banking refers to financial activities not conducted within traditional banking systems, but consist of lending, borrowing, and liquidity provision in decentralized environments. It poses risks associated with lack of regulation, transparency, and consumer protections. Question 48. How do community-driven projects differ from traditional corporate structures in decision-making? Community-driven projects often prioritize decentralized governance, where token holders participate in proposals and voting, allowing for collective decision-making. In contrast, traditional corporate structures have centralized authority, where a board or executives make decisions typically without direct input from shareholders. Question 49. What challenges arise with regard to scalability solutions like Layer 2 solutions? While Layer 2 solutions improve scalability and reduce transaction costs, challenges include security trade-offs, user adoption, potential centralization issues, and the complexity of transferring assets between Layer 1 and Layer 2, which can deter user confidence. Question 50. How is user privacy protected in decentralized exchanges compared to centralized exchanges? Decentralized exchanges typically allow users to trade directly from their wallets without the need to provide personal information, enhancing privacy. In contrast, centralized exchanges require KYC, Know Your Customer procedures, which can expose user data to risks of breaches or misuse. Question 51. What are the key differences between proof of work, POW, and proof of stake, POS? Proof of work requires miners to solve complex mathematical problems to validate transactions and secure the network, consuming significant computational resources and electricity. Proof of stake, on the other hand, allows validators to create new blocks based on the number of coins they hold and are willing to stake, resulting in lower energy consumption and incentivizing long-term holding. Question 52. How do decentralized finance DeFi platforms operate, and what risks do they pose to users? DeFi platforms use smart contracts on blockchains to provide financial services like lending, borrowing, and trading without intermediaries. Risks include smart contract vulnerabilities, market volatility, and systemic risks stemming from interconnected DeFi protocols that can lead to cascading failures. Question 53. What is the concept of an initial coin offering, ICO, and how does it differ from a security token offering, STO? An ICO is a fundraising mechanism where new cryptocurrencies are sold to investors, often without regulatory oversight. In contrast, an STO involves the issuance of security tokens that are compliant with securities regulations, providing investors with legal protection and potential dividends. Question 54. How does the consensus mechanism affect the scalability of a blockchain? Different consensus mechanisms like POW and POS affect scalability by determining how quickly transactions can be processed while maintaining security. For example, POW often struggles with scalability due to high energy consumption and longer block times, whereas POS can process transactions more quickly and efficiently. Question 55. What are oracles in blockchain technology, and why are they important? Oracles are third-party services that provide real-world data to smart contracts on a blockchain, enabling them to interact with external information such as market prices or sports scores. They are vital for the functioning of DeFi apps and other dApps that rely on real-time data to make decisions. Question 56. How does the concept of a blockchain fork function, and what are the types of forks? A blockchain fork occurs when there is a change to the protocol of a blockchain, resulting in a divergence. The two main types are hard forks, which create a permanent split, resulting in two separate chains, and soft forks, which are backward compatible changes that do not create a new chain. Question 57. What are the potential environmental impacts of Bitcoin mining? Bitcoin mining, especially through POW, can lead to significant energy consumption and carbon emissions, contributing to climate change. The environmental impact varies based on the energy sources used. Mining operations powered by renewable energy are less harmful. Question 58. How can regulatory frameworks affect the adoption and innovation in the cryptocurrency industry? Regulations can provide clarity and legitimacy, fostering innovation and user trust, while protecting against scams and fraud. However, overly stringent regulations may stifle innovation and deter companies from entering the market, hindering growth. Question 59. What is the role of crypto wallets in the ecosystem, and how do they differ? Crypto wallets are tools for storing, sending, and receiving cryptocurrencies. They differ in type: hot wallets, online, convenient but less secure, and cold wallets, offline, more secure but less accessible. The security features and usability vary widely among different wallets. Question 60. What are Layer 2 solutions, and how do they enhance blockchain scalability? Layer 2 solutions are secondary frameworks built on top of existing blockchains to improve scalability and transaction speed. Examples include the Lightning Network for Bitcoin and ZK rollups for Ethereum, which allow for off-chain transactions that are later settled on the main chain, reducing congestion. Question 61. How do stablecoins maintain their peg to fiat currencies, and what mechanisms are used? Stablecoins usually maintain their peg through collateralization, backed by fiat or other assets, or algorithmic methods, adjusting supply based on demand. Collateralized stablecoins require reserves held in trust, whereas algorithmic stablecoins use smart contracts to manage supply in response to market fluctuations. Question 62. What challenges do decentralized autonomous organizations, DAOs, face in governance? DAOs face challenges like ensuring effective decision-making, preventing abuse of power, managing diverse stakeholder interests, and navigating legal recognition. The reliance on voting mechanisms can also lead to low participation rates, impacting the DAO's functionality. Question 63. In what ways can blockchain technology enhance supply chain management? Blockchain can enhance supply chain management by providing transparency, traceability, and security, allowing stakeholders to track products throughout the supply chain while verifying authenticity and reducing fraud. Smart contracts can automate processes and improve efficiency. Question 64. What are the security implications of using multi-signature wallets? Multi-signature wallets require multiple private keys to authorize transactions, enhancing security by reducing the risk of a single point of failure. However, they can complicate access and recovery processes if not set up correctly, and they may become targets for sophisticated attacks. Question 65. How do concepts like tokenomics influence the success of a cryptocurrency project? Tokenomics refers to the economic model of a cryptocurrency, including supply, distribution, and incentives for users. A well-designed tokenomics model can drive demand, encourage participation, and ensure the sustainability of a project, while poorly thought-out models can lead to volatility and abandonment. Question 66. What is the significance of the Byzantine generals problem in blockchain technology? The Byzantine generals problem illustrates the challenge of achieving consensus among decentralized parties in the presence of faulty or malicious nodes. Solutions like consensus algorithms are developed to ensure network security and reliability despite the possibility of deceptive behavior. Question 67. How can privacy coins like Monero and Zcash impact regulatory frameworks? Privacy coins use advanced cryptographic techniques to obscure transaction details, complicating regulatory oversight aimed at preventing money laundering and other illicit activities. This poses challenges for jurisdictions seeking to enforce compliance while respecting user privacy. Question 68. What are the implications of central bank digital currencies, CBDCs, on existing cryptocurrencies? CBDCs could provide a more stable digital currency alternative, potentially competing with existing cryptocurrencies. They may influence adoption rates, regulatory treatment, and the overall landscape of digital payments, enabling governments to exert greater control over monetary policy. Question 69. How do blockchain-based identity solutions enhance data privacy? Blockchain-based identity solutions enable users to control their personal data, presenting verified credentials without exposing sensitive information. This decentralized approach enhances privacy and security while reducing the risk of identity theft. Question 70. What is the role of governance tokens in decentralized finance ecosystems? Governance tokens grant holders the power to influence protocol decisions, such as changes to the protocol, funding allocations, and upgrades. They incentivize community involvement and align the interests of users and investors with the long-term success of the ecosystem. Question 71. How do we assess the value of a cryptocurrency beyond its price? Assessing the value of a cryptocurrency involves evaluating factors such as use case utility, technological fundamentals, adoption rates, community engagement, developer activity, and overall market sentiment. These metrics provide insight into the project's long-term viability and potential for growth. Question 72. What are the main factors contributing to the volatility of cryptocurrencies? The volatility of cryptocurrencies can be attributed to speculative trading, market sentiment influenced by news and events, regulatory developments, liquidity levels, and the relatively nascent stage of the cryptocurrency market, which leads to rapid price swings. Question 73. How do flash loans work, and what are their implications for the DeFi ecosystem? Flash loans allow users to borrow assets without collateral, provided the loan is repaid within the same blockchain transaction. They enable arbitrage opportunities but pose risks, including market manipulation or exploitation of vulnerabilities in protocols, which can lead to significant losses. Question 74. What makes a cryptocurrency immune to inflation, and how is scarcity maintained? Cryptocurrencies like Bitcoin are designed with a capped supply, 21 million for Bitcoin, to maintain scarcity, making them relatively immune to inflation. This contrasts with fiat currencies, which can be printed in unlimited amounts by central banks, leading to devaluation. Question 75. How does the concept of digital scarcity differ from physical scarcity? Digital scarcity is established through algorithms and protocol rules that limit supply, like Bitcoin's fixed cap. Physical scarcity is based on the availability of material resources in the real world. Digital scarcity allows for fractional ownership and new economic models, while physical scarcity is subject to resource limitations. Question 76. What strategies can be employed to mitigate risk in cryptocurrency investments? Strategies include diversifying portfolios, conducting thorough research on projects, setting stop-loss orders, staying informed about market trends, using dollar-cost averaging, and only investing what one can afford to lose to minimize exposure to extreme volatility. Question 77. How do blockchain explorers contribute to transparency and accountability? Blockchain explorers allow users to view and verify transactions on a blockchain, contributing to transparency by enabling public access to transaction histories. This accountability fosters trust in blockchain networks and deters fraudulent activities. Question 78. What implications do security vulnerabilities in smart contracts have for the broader DeFi space? Security vulnerabilities in smart contracts can lead to significant financial losses, eroding user trust in DeFi platforms. Incidents such as hacks or exploits can also result in regulatory scrutiny, impacting the growth and adoption of DeFi as a whole. Question 79. What is the significance of liquidity pools in decentralized exchanges, DEXs? Liquidity pools are collections of funds provided by users to facilitate trading on DEXs, ensuring that there are enough assets available for trading. They enable automated market making and reduce reliance on traditional order books, promoting efficient and decentralized trading. Question 80. How do cross-chain solutions enhance interoperability in the cryptocurrency ecosystem? Cross-chain solutions enable the transfer of assets and information between different blockchains, promoting interoperability and allowing users to leverage multiple networks. This enhances liquidity, expands use cases, and fosters collaboration among various blockchain platforms. Question 81. In what ways can algorithmic stablecoins maintain stability without collateral? Algorithmic stablecoins maintain stability through supply and demand mechanisms, adjusting their supply in response to price fluctuations. For instance, if the price rises above the target, the protocol might issue more tokens to increase supply, thereby lowering price pressure. Question 82. What are the potential risks associated with yield farming in DeFi? Yield farming can present risks such as smart contract vulnerabilities, impermanent loss when liquidity is provided, and market volatility affecting asset values. Additionally, the complexity of strategies can lead to mismanagement and unexpected losses. Question 83. How do transaction fees impact user behavior in cryptocurrency networks? High transaction fees can deter users from conducting small transactions, leading to decreased network usage and lower demand for the cryptocurrency. Conversely, low fees can encourage greater participation, facilitating economic activity within the network. Question 84. How can hackers exploit vulnerabilities in DeFi protocols, and what measures can be taken to secure them? Hackers can exploit smart contract vulnerabilities, manipulate price feeds, or take advantage of poorly designed liquidity pools. Securing DeFi protocols involves code audits, implementing bug bounties, and utilizing insurance protocols to safeguard against potential exploits. Question 85. What is the significance of community engagement in the development of cryptocurrency projects? Community engagement fosters user loyalty, provides valuable feedback for project improvement, and drives grassroots marketing efforts. Strong communities can influence governance decisions, ensuring that projects remain aligned with the needs and interests of their users. Question 86. How does the scalability trilemma challenge blockchain developers? The scalability trilemma posits that blockchain networks must balance three key features: decentralization, security, and scalability. Achieving optimal levels in all three simultaneously is challenging, often forcing developers to prioritize certain aspects over others. Question 87. What are the implications of token burns on cryptocurrency supply and price dynamics? Token burns permanently remove tokens from circulation, reducing supply and potentially increasing the remaining tokens' scarcity and value. This deflationary mechanism can create positive price pressure if demand remains constant or increases. Question 88. How does transaction confirmation time influence user experience in cryptocurrency transactions? Longer transaction confirmation times can lead to user frustration and limit the practical use of cryptocurrencies for everyday transactions. Efficient confirmation processes enhance user experience, encouraging broader adoption as a medium of exchange. Question 89. What is liquidity mining and how does it incentivize participation in DeFi protocols? Liquidity mining rewards users for providing liquidity to DeFi platforms by distributing governance tokens or other incentives. This encourages participation in liquidity pools, enhancing the protocol's overall stability and functionality by ensuring sufficient assets for trading. Question 90. How do emerging technologies like Layer 1 and Layer 2 introduce innovation in blockchain scalability? Layer 1 solutions enhance the base layer of a blockchain through protocol upgrades, while Layer 2 solutions like sidechains build on top to offload transactions and increase throughput. Both approaches aim to address scalability challenges, improving user experience and network performance. Question 91. What role does artificial intelligence play in the cryptocurrency market? Artificial intelligence is utilized in cryptocurrency trading for predictive analytics, automated trading strategies, sentiment analysis, and risk assessment. AI can enhance market decision-making, optimize trading efficiency, and facilitate better investment strategies. Question 92. How does the rise of meme coins like Dogecoin influence market trends and investor behavior? Meme coins often gain popularity through social media and community movements, leading to speculative trading and volatility. Their impact on market trends can distort traditional analysis, showcasing the influence of community sentiment over fundamental value in the crypto space. Question 93. What are the major differences between CEXs, centralized exchanges, and DEXs, decentralized exchanges? CEXs are managed by centralized entities, providing user-friendly interfaces, but imposing withdrawal limits and requiring personal information. DEX, on the other hand, allow peer-to-peer trading without intermediaries, offering greater privacy, but often lacking user-friendliness and robust customer support. Question 94. How do forks affect existing token holders in blockchain networks? Forks can create new tokens that may be distributed to existing holders. Token holders may have a stake in both chains post-fork, allowing for potential profits or losses based on the success of each network. However, not all forks benefit existing holders equally. Question 95. What are the implications of using cryptography for securing digital identities? Cryptography ensures secure storage and transmission of personal data, reducing vulnerabilities to identity theft and fraud. By leveraging cryptographic techniques, users can maintain privacy and control over personal information, leading to more secure digital interactions. Question 97. In what ways can social media platforms influence cryptocurrency adoption and trends? Social media platforms serve as vital channels for information dissemination, community building, and marketing for cryptocurrencies. Influencers can significantly sway public sentiment, driving adoption or speculation, while trends can rapidly change due to viral content. Question 98. How can educational initiatives promote safer cryptocurrency investment practices? Educational initiatives can inform users about the risks and benefits of cryptocurrencies, guiding them on due diligence, secure storage, and market analysis. Knowledgeable investors are more likely to make informed decisions, reducing the incidence of fraud and losses. Question 99. What ethical considerations arise with cryptocurrency mining, particularly in relation to energy consumption? Ethical considerations include evaluating the environmental impact of energy-intensive mining operations and the sustainability of resources used. Communities are increasingly scrutinizing mining practices, advocating for greener alternatives to address ecological concerns. Question 100. How might the future of cryptocurrency evolve with advancements in technology? The future of cryptocurrency could see enhanced scalability, interoperability, and user experience driven by technological innovations. Improvements in security protocols, widespread adoption of CBDCs, and integration with traditional financial systems may redefine the cryptocurrency landscape. Question 101. What are the main psychological factors influencing investor behavior in cryptocurrencies? Psychological factors such as fear of missing out, FOMO, loss aversion, and herd mentality significantly influence investor behavior. These emotions can lead to impulsive decisions, causing investors to buy during price increases and sell during downturns, which can exacerbate market volatility. Question 102. How do non-fungible tokens, NFTs, challenge traditional concepts of ownership and value? NFTs represent unique digital assets verified on the blockchain, challenging notions of ownership by providing a proof of authenticity and ownership in a digital space. They shift value perceptions by emphasizing scarcity and provenance rather than the asset's utility, leading to new markets and forms of expression. Question 103. What are the potential applications of blockchain technology in the healthcare sector? Blockchain can enhance healthcare by improving data interoperability, ensuring secure patient records, streamlining supply chain management for pharmaceuticals, and enabling tracking of clinical trials. These applications can enhance data integrity, ensure privacy, and facilitate secure sharing of medical data. Question 104. How can regulatory compliance impact the future development of cryptocurrency projects? Regulatory compliance can shape cryptocurrency projects by necessitating adherence to laws governing securities, anti-money laundering, AML, and data protection. Compliance can enhance legitimacy and investor confidence, but overly restrictive regulations may stifle innovation and deter new projects. Question 105. In what ways can cryptocurrency mining pools affect the decentralization of networks? Mining pools allow miners to combine resources to increase their chances of successfully mining blocks, leading to more stable revenue streams. However, if a few large pools dominate the network, it can compromise decentralization, making the blockchain vulnerable to attacks and central control. Question 106. How does the concept of gas fees work in platforms like Ethereum, and what factors influence their volatility? Gas fees are transaction fees paid to miners for processing transactions on platforms like Ethereum. They fluctuate based on network congestion, the complexity of transaction computations, and overall demand for block space, resulting in periods of high fees during peak usage times. Question 107. What role do venture capitalists play in the cryptocurrency ecosystem, and how does their involvement impact startups? Venture capitalists provide funding and strategic guidance to cryptocurrency startups, facilitating growth and innovation. Their involvement can validate projects, attract more investors, and offer industry connections. However, the need for rapid returns can also lead to pressure for short-term focus over long-term sustainability. Question 108. How does the concept of digital ownership differ between blockchain and traditional systems? Digital ownership on blockchain is decentralized and secured through cryptographic principles, allowing users to control their assets without intermediaries. In contrast, traditional systems rely on centralized authorities to manage ownership, which can introduce risks of fraud, counterfeiting, and data breaches. Question 109. What are some ethical considerations surrounding privacy coins and their use in illicit activities? Privacy coins facilitate anonymous transactions, raising ethical concerns about their potential use in money laundering, tax evasion, and financing illegal activities. While they offer legitimate privacy benefits, striking a balance between user privacy and regulatory compliance remains a complex challenge. Question 110. How can community governance models influence the long-term sustainability of cryptocurrency projects? Community governance models empower token holders to participate in decision-making processes, aligning project direction with user interests. This inclusivity can enhance project sustainability by fostering loyalty, improving transparency, and adapting to community feedback, ultimately driving long-term success. Question 111. What are the potential consequences of forking a blockchain, both for developers and users? Forking a blockchain can lead to the creation of two distinct networks, affecting developers and users differently. Users may receive new tokens but could face confusion and volatility in token value. Developers must manage the fork's implications for ongoing support, potential project fragmentation, and community sentiment. Question 112. How do decentralized identity solutions leverage blockchain technology to enhance security? Decentralized identity solutions use blockchain to allow users to control and verify their own identities without relying on a centralized authority. This reduces the risk of data breaches and identity theft while enabling secure access to services through cryptographic authentication. Question 113. What impact does the introduction of central bank digital currencies, CBDCs, have on existing cryptocurrencies? CBDCs could provide a government-backed alternative to cryptocurrencies, potentially impacting their perceived legitimacy and usability. While CBDCs might increase overall cryptocurrency adoption, they could also lead to increased regulatory scrutiny and competition for market share. Question 114. How can the concept of digital twins be applied in conjunction with blockchain technology? Digital twins are virtual replicas of physical assets or systems, and integrating them with blockchain can enhance tracking and validation of data in real time. This combination can be applied in areas such as supply chain management, enabling increased efficiency, transparency, and accountability. Question 115. What are the implications of network effects in the adoption of cryptocurrencies? Network effects suggest that as more users adopt a cryptocurrency, its value and utility increase, making it more attractive to new users. This creates a positive feedback loop that can drive exponential growth, though it can also lead to eventual saturation and competition among similar coins. Question 116. What is the significance of crypto tax regulations in encouraging or deterring cryptocurrency investment? Clear and fair crypto tax regulations can foster confidence among investors, encouraging compliance and long-term investment. Conversely, complex or punitive tax regulations may deter participation, leading individuals to avoid or reduce their exposure to cryptocurrencies, stunting market growth. Question 117. How can artificial intelligence and machine learning optimize trading strategies in the cryptocurrency market? AI and machine learning can analyze vast data sets to identify trends, patterns, and correlations in cryptocurrency markets, enabling traders to develop more accurate predictions and optimize trading strategies. These technologies can mitigate risks and enhance decision-making processes in a volatile market. Question 118. What challenges do cryptocurrencies face in achieving mainstream adoption as a means of payment? Challenges include regulatory hurdles, volatility in value, scalability issues, limited acceptance by merchants, and technological barriers for users unfamiliar with crypto. Further education and infrastructure development are needed to facilitate smoother usage for everyday transactions. Question 119. How does the diminishing reward for mining Bitcoin affect its long-term sustainability? The diminishing block reward is designed to reduce supply over time, reinforcing Bitcoin's scarcity and potentially driving its value higher. However, this can also impact miners' profitability and overall network security if transaction fees do not compensate for lower mining rewards. Question 120. What role does community-led development play in the evolution of open-source cryptocurrencies? Community-led development fosters innovation and responsiveness to user needs in open-source cryptocurrency. It allows for collaborative problem-solving, faster deployment of updates, and a sense of ownership among participants, leading to sustained engagement and project growth. Question 121. How do consensus mechanisms differ between proof of work, POW, and proof of stake, POS, and what are their respective advantages and disadvantages? POW relies on miners solving complex mathematical problems to validate transactions and create new blocks, requiring significant computational power and energy. Its advantages include robust security and decentralization, but it faces criticisms for its environmental impact and scalability challenges. POS, conversely, allows validators to create new blocks based on the number of coins they hold and are willing to stake, which consumes less energy and can achieve faster transaction speeds. However, it may lead to centralization, as those with more tokens have more power, potentially creating inequality within the network. Question 122. What are the underlying technical challenges of achieving scalability in blockchain networks? Scalability challenges in blockchain arise from limitations in transaction throughput, block size, and confirmation time. Solutions like sharding, dividing the blockchain into smaller pieces, and layer 2 protocols like the Lightning Network for Bitcoin seek to mitigate these issues. However, achieving a balance between increasing capacity while maintaining security and decentralization remains a complex technical problem. Question 123. In what ways can regulatory uncertainty and compliance challenges impede the growth of decentralized finance? DeFi. Regulatory uncertainty creates an unpredictable environment for DeFi projects, leading to hesitance among investors and developers. Compliance challenges, such as adhering to anti-money laundering, AML, and Know Your Customer, KYC regulations, can hinder the innovation of DeFi services. Additionally, the potential for future regulations to impose strict frameworks may force some projects to shut down or centralize, undermining the foundational principles of decentralization. Question 124. How does the concept of crypto-economic security apply to decentralized networks, and what factors influence it? Crypto-economic security refers to the mechanisms ensuring that participants in a decentralized network act honestly and maintain the network's integrity. Factors influencing it include token economics, supply, demand, and incentives, the staking mechanism in POS networks, the number of active users, and overall network decentralization. A robust design that aligns incentives can minimize the risk of malicious actions that compromise security. Question 125. What implications does the emergence of cross-chain interoperability solutions have for the future of blockchain ecosystems? Cross-chain interoperability solutions enable different blockchains to communicate and share data, which could enhance user experience and broaden the utility of cryptocurrencies. This fosters a more connected blockchain ecosystem, allowing for greater innovation in application development, combined liquidity pools, and cross-platform DeFi services. However, achieving seamless interoperability carries risks related to security and complexity, necessitating rigorous protocols to prevent exploits. Question 126. In what ways can the energy consumption of blockchain networks be measured and compared effectively? Measuring energy consumption involves assessing the computational power required for transaction validation. Metrics such as the total power consumption of mining farms in POW networks versus the energy spent per transaction in POS networks provide insights. Comparative evaluations may also include assessments of energy sources, renewable versus fossil fuels, and the broader environmental impact of blockchain operations. These comparisons can inform discussions on sustainability and guide the development of greener alternatives. Question 127. How can tokenomics influence user behavior and investment decisions within a cryptocurrency ecosystem? Tokenomics encompasses the economic principles governing the issuance, distribution, and utility of tokens within a cryptocurrency ecosystem. Factors like total supply, inflation rate, utility, and governance can influence user perception and behavior. For instance, tokens with clear use cases and a deflationary model may attract more investors, while excessive inflation or lack of utility can lead to decreased interest and participation. Question 128. What are the risks associated with the use of smart contracts, and how can they be mitigated? Smart contracts, while enabling trustless interactions, are susceptible to bugs, coding errors, and security vulnerabilities that can be exploited. Risks include unintentional loss of funds and the inability to modify deployed contracts. Mitigation strategies involve thorough code audits, formal verification processes, and employing security testing tools. Additionally, incorporating upgradable smart contracts can help address issues post-deployment, although this introduces trade-offs in decentralization. Question 129. How does the concept of privacy in cryptocurrencies like Monero differ from Bitcoin, and what are the implications for law enforcement? Monero employs advanced cryptographic techniques such as ring signatures, stealth addresses, and confidential transactions to provide enhanced privacy compared to Bitcoin, where transactions are pseudonymous but publicly traceable on the blockchain. These privacy features complicate law enforcement efforts as they hinder transaction tracing and identification of users. While privacy can protect users from surveillance, it also raises concerns about facilitating illicit activities. Question 130. What ethical considerations arise from the development and use of algorithmic stablecoins, especially regarding market stability? Algorithmic stablecoins aim to maintain value stability through market mechanisms rather than collateralization, raising ethical questions about their reliability and potential for systemic risk. Concerns include the ability to maintain peg during market volatility, transparency of the underlying algorithms, and potential manipulation by large holders. These factors necessitate transparent governance and robust risk management strategies to ensure user trust and market stability. That's all for today. In the description, you'll find important links to better understand cryptocurrency products. Thanks for listening, and we'll see you another time. Cheers.